Hello and welcome to today's business news headlines. Today we're going to be talking about Delta Airlines and other airlines, major airlines in the United States that have overshot or overestimated how much traffic they were going to get and how now they have to scale back. There's a lot of problems going on with booking and with delayed flights. So we're going to be reading an article about that. And we're also going to be talking about job shortages and firings from 7-Eleven and Domino's and everything that's happening in the market with those two companies. We're also going to be talking about Twitter and how Elon Musk's acquisition of Twitter is going. And finally, we're going to talk about Netflix and how the market is moving for entertainment industries and for the big players like Netflix. So let's get started with the first article, which is about airlines. And I'm just going to go ahead and read the headline. It says, "Airlines were too ambitious chasing the travel rebound," which is what everybody was expecting to happen after COVID, was that there was going to be this rush to getting back to a lot of travel and tourism, and everything was just going to go back to being pre-pandemic times. And that happened to a certain degree. There was um, some projections that they had made that were completely wrong, and it has turned out to be quite a mess for all these travel companies, and now they have to deal with the fallout. So let's get to the main points. It says Delta and United American all posted a profit thanks to strong travel demand and high fares, and flight disruptions are up compared to 2019, even before the COVID pandemic hit. And we also have the three biggest U.S. carriers are dialing back their flight growth plan. Continuing on, it says the leaders of the country's biggest airlines learned a hard lesson this summer. It's easier to make plans than to keep them. The three biggest U.S. carriers, Delta, United, and American Airlines, are dialing back their flight growth ambitions in an effort to fly more reliably after biting off more than they could chew this year as they chased an unprecedented rebound in travel. So the rebound did happen. There was a lot of influx of people that wanted to travel. This did lead to some delays. Let's just keep reading on. It says the cuts come as airlines face elevated costs that they don't see easing significantly just yet, along with the possibility of an economic slowdown and questions over spending by some of the country's biggest corporate travels. So they are still afraid that, I'm sorry, they are still afraid that we're not quite out of the woods yet, and this influx in travel is temporary. So it's kind of hard to tell where we are at with the pandemic. Some people say that we're out of the woods. Some people say that the worst is still yet to come. So the jury's still out on that one. And I can totally see why a lot of the airlines are confused with their projections about how travel is going to be affected within the next year. Um, so building buffers, it says United Airlines estimated it would restore 89% of 2019 capacity levels in the third quarter and about 90 in the fourth. Into 2023, it will grow its schedule to no more than 8% above 2019's, down from earlier forecasts that it would fly 20% more than it did in 2019 before the COVID pandemic has strong travel. So it's basically a summarized paragraph of what we've already said. They projected that they were going to go back to post-pandemic traffic, and it wasn't that way. We're essentially going to keep flying the same amount that we are today, which is less than we intend to, but not grow the airline until we can see evidence that the whole system can support it. So they are waiting for confirmation about what's going to happen with travel. They're playing it safe. Um, So if you did face a lot of delays, if you are constantly traveling and you did experience some canceled flights, it's because of this, because the airlines don't know if the traffic is permanent, they don't know if they're going to grow, and then have to make more cutbacks later on. Uh, and it's a very confusing time for a lot of industries. No one is safe at this moment, and the airlines least of it. So that's basically the main message, and I'm going to move on to the next article, which is the article about 7-Eleven. It says convenience stores chain 7-Eleven cuts 880 corporate jobs as part of a restructuring. And here are the main points. Convenience stores chain 7-Eleven has slashed roughly 880 corporate jobs in the United States. And I want to make emphasis here on corporate jobs. So there are a lot of major companies that are downgrading, that are finding out who is essential to their corporate positions, or which corporate positions are essential to the function of a lot of companies. There are cutbacks, and 7-Eleven is just one of them. Continuing, it says the eliminations come roughly after a year it has completed its 21 billion acquisition of rival C-store business Speedway. The cuts were of certain jobs in the company's Irving, Texas, and Ohio support centers, as well as field support roles, according to the company spokesperson. So these are what I get from this is that they're saying that they're not cutting jobs from the people that are like tending or affecting, middle class employment over here. They're talking about corporate positions. So it seems like there's a little bit of fat to cut from this turkey, and uh, yeah. So let's continue reading. It says convenience store chain 7-Eleven has cut roughly 880 corporate jobs in the United States. CNBC has learned roughly a year after it completed its 21 billion acquisition of rival C store, convenience store, and gas station business Speedway. 7-Eleven is owned by Japanese retail conglomerate. Wow, I didn't know that 7-Eleven was owned by a Japanese retail conglomerate. Um, I always assumed it was an American owned company, maybe owned by some type of ethnic group in in the United States, but I didn't know it was a Japanese retail conglomerate. Seven and I Holdings, which came under pressure earlier this year from San Francisco-based investment company Value Act Capital to consider strategic alternatives. Value Act has been urging Seven and I to narrow its focus to 7-Eleven, and it backed a new slate of directors on the Japanese company board. I don't really know what that means. More recently, business in the US have been grappling with inflation on everything from fuel to labor to rent, which are weighing on profits. Many companies are now either hitting the brakes or on hiring, or beginning to lay people off as they look for opportunities to slash expenses. And this is always what happens. The company wants to keep its profit. There are several companies, which I think is a really good point to talk about, that when inflation hit, they refused to increase their prices. They refused to pass on the costs that are being elevated for them onto the customer, and instead they kept the same pricing. One example of this is Arizona iced tea, which I can look for an article in a moment. But not all of the companies are passing on this responsibility onto the consumer. And not all the companies are laying off. There are some companies that are just saying, "Hey, you know what? We have enough money to take it. We have enough money to take the loss during 1 year, during 5 years." There's, major companies can often run on losses, and they'll probably be fine. So that might be the case with 7-Eleven. Let's continue. It says 7-Eleven has also been contending with higher prices at gas pumps, which have led some consumers to hold off on filling up the tank or buying extra goods inside of its retail stores. And as we know, the gas is just the hook. Where they really make their profits um, is with all the stuff that they sell you inside of the gas station. So let's take that into consideration. It says 7-Eleven operates more than 13,000 locations across North America, and according to its parents company, most recently annual filing, roughly 9,500 of which are under its namesake banner. So there are other convenience stores that are owned by this Japanese conglomerate, but they are not named 7-Eleven. The company didn't immediately confirm how many employees it has in the US. As with any merger, our integration approach includes assessing our combined organization structure, a 7-Eleven spokesperson told CNBC in an email statement. The review was slowed by COVID 19, but it's now complete, and we're finalizing this go forward organization structure. So the article goes on, but that's the gist of it. 7-Eleven is cutting back on corporate jobs. That means that, if we believe what the spokesperson is saying, which we should always take what people are saying with a grain of salt, because that's their job to what is it called? Um, Public relations, to make everything seem like it's always great. We don't have to believe it, but definitely there are some cutbacks happening for a lot of the industries. As we just saw, the airline industries and the travel industry is affected. Over here, convenience stores. And let's go on to talk about food with Domino's. Oh, no. No, no, no. No, no, no. Okay, yes. I thought I closed the recording. Thank the Lord. Okay, Domino's. Earnings miss expectations as pizza chain struggles with driver shortages and higher costs. So here are the main points. Domino's Pizza missed Wall Street expectations for its second quarter earnings, so they did not hit their mark. Domino's, the pizza giant, has not met their goals for second quarter earnings, but beat estimates for its revenue. The pizza chain raised its outlook for food prices for fiscal year 2020. The ongoing shortage of delivery drivers hurt the chain sales again this quarter. So and this is just an ongoing issue in the United States, that there's both unemployment and open vacancies for work that a lot of people are considering is underpaid, and therefore they don't want to participate in those jobs until the wages are raised. And it doesn't really matter how much the wages are raised. If other things continue to get more expensive, um, those the wages are never going to be able to catch up. So I believe that there's a disconnect, how people are valuing things and how people are assessing how much people need to get paid. I think that during this shakeup in the pandemic, a lot of things have been moving around, and a lot of industries are being reassessed about their value. And I just hope that we find a stable place soon, because a lot of the problems that we're getting is because of uncertainty, and we just saw that in the article with the airlines. It's hard to predict how things are going to move, and even though we cannot predict the future, projections do help with especially if you're a big company, how much you're going to hire, uh, how much you're going to pay for all of your expenses. And, there's a lot of live calculations that need to happen. And with everything that's going on with the pandemic, it's really, really hard to predict. So I can totally understand why there, a lot of people don't want these jobs. A lot of people maybe want other jobs. Some people don't know if, even big companies are going to survive. So, yeah, a lot of moving parts. Let's go on. It says Domino's Pizza on Thursday reported mixed quarterly results as the pizza chain struggles with higher costs and ongoing shortages of delivery drivers. I can assure you that nobody at Domino's Pizza is happy with our recent performance, says CEO Russell Weiner, and he told analysts on a conference call. The Ann Arbor, Michigan based company's same store sales fell at home and abroad during the second quarter. Sales in the US have been hurt by some locations shortening their hours as a result of their driver shortage. To address customer service difficulties, roughly 40% of Domino's US restaurants are using call centers to take orders so their workers can focus on making and delivering pizzas. And this is actually quite interesting because I reside in Mexico, and I some of my friends actually have been hired uh, for these call centers. So it's very interesting. But if you make a call to Domino's Pizza in the United States, you might be transferred to a call center in another country, be it Mexico or India, anywhere that it's cheap, where it's cheap to get the labor. These jobs are being exported. I have a huge beef with that. It might be personal, it might be biased, but um, they're looking to pay people less for the I don't know. I think it's helpful for a lot of people. I mean, they are exporting jobs to countries that need good, high paying jobs, but they are also not offering tenure or whatever it's called. They're not offering any type of benefits. And I believe that while they are paying good wages outside of the US compared to what other companies within those countries can pay, it's still they should offer something that people can live off of and get benefits from and things like that. So I just wish that when they export these jobs to other countries, that they are also helping with other things like medical expenses and things like that. So it says Domino's also said it expects food costs to keep rising and unfavorable foreign currency exchange rates to drag down its international revenue more than previously forecast. So they're talking about also their international deals over here. Shares of Domino's were up modestly in afternoon trading. Here's what the company reportedly prepared with Wall Street was expecting based on surveys of analyses by Refinitiv. Earnings per share $2.82 versus $2.91 expected, so it's a few cents off. Uh, it can mean a lot actually. Revenue 1.07 billion versus 1.05 billion expected. So while their earnings per share or how the company is valued didn't hit the expectation, they still hit their revenue mark and exceeded it a little bit. So it says net income in 3 months period ended June 19th was 105 million or $2.82 per share, down from 116.6 million or $3.06 per share a year earlier. So they're not back to their all-time high, but they're getting there. So it seems that a lot of people still value the convenience of fast food that can be delivered like Domino's. So That's the news over here for Domino's, and we're going to go on to the next article, which speaks about something that is very popular right now, which is Twitter and the Twitter war with Elon Musk. Sorry. And over here we have the article that says Twitter wins bid for expedited trial to force Musk to close 44 billion acquisition. A 5-day trial is now set to start in October, and Musk wanted a trial to commence next year. Obviously, he wants to push it forward, but the powers that be want to go forward more quickly this year in October. And they're actually doing this so quickly because they're using a court in the United States that specializes in these big mergers, through these big companies. They do that very often, and we could see a resolution within this year, which is very, very fast for any litigation. So it says Twitter won its motion for an expedited trial in its lawsuit against Elon Musk on Tuesday. So huge win for Twitter. They're expediting this deal, this matter, in the Delaware Court of Chancery. In the Delaware court, because this Delaware court specializes in these types of big business deals, these big mergers. So it says Delaware Court of Chancery Chancellor Kathleen McCormick ruled in favor of an expedited 5-day trial to take place in October. 5-day trial, wow. The Amber Heard versus Johnny Depp trial was what was it, like 3 or 4 weeks, but this acquisition trial is going to be expedited 5-day trial, which is absolutely amazing how this can work, to take place in October. Twitter is seeking to enforce Musk's 44 billion acquisition of the company, despite Musk's intention to back out of the deal. Is that his intention? Was that always his intention? I don't know. There's a lot of speculation. We also have a theory that Elon Musk is simply trying to drive the price of Twitter down enough so that it becomes a really great deal for him. It could be that he could be the puppet master that is controlling everything, playing 5-head moves, or it could be that he's just overconfident and a little bit crazy with power. It says that, or it is well known that power corrupts, and absolute power corrupts absolutely. So it could be a case of that for Elon Musk. And we just have to wait and see. And the good part about this is that we won't have to wait too long. Let's see, we are in July 22nd, July, August, September, October. So that's within 3 months, absolutely blazing through this process. And we could see a resolution very, very quickly about this. The legal squabble, it says, to be tried in the Delaware Court of Chancery stems from Musk's decision to terminate his 44 billion acquisition of Twitter. Musk, via his attorneys, sent a letter to Twitter chief legal officer Vijayagar in July, explaining why the billionaire believed his acquisition should no longer proceed. I believe he mentioned something about Twitter not giving enough information about the bots and what percentage of the profiles on Twitter are actual bots. Twitter said it was around 95%, and Musk argues it's something between 7 and 15%. The legal channels that I follow, I'm not an expert, obviously a legal expert, but the legal channels that I follow are saying that this wouldn't be a material enough change for Musk to cancel completely the deal, but it could force a repricing of the shares. Of course, Musk offered $54.20 as a reference to 420. Um, I don't know how this deal got started in the first place. It was obviously a meme, but so weird, so weird, a little bit frustrating. And to be sincere, I do want this deal to go through because I can't understand for the life of me how somebody could just throw something so serious as a game. So it says, sent a letter to Twitter. The lawyers allege that Twitter underreported the number of spam and fraud accounts on its messaging service and failed to send Musk information that could presumably help the executive better calculate those statistics. Twitter later sued Musk and some of his associates in late July over allegations that the billionaire refused to honor his obligations to Twitter and its stockholders because the deal he signed no longer served his personal interest. At the time, Twitter was seeking a 4-day trial to commence in September. Musk and his attorney, however, later asked the court to deny Twitter's request for a fast trial. Instead, the billionaire and his lawyers want a court trial to take place next year, alleging that Twitter initiated a sudden request for warp speed after Twitter initiated a sudden request for warp speed. Wow, the language these lawyers use. Very colorful, and of course trying to make their argument that this is this is going way too fast. But these courts are specialized. The Delaware court is specialized in mergers and big business deals, so I'm sure that there would be no problem with going ahead sooner rather than later. It says sudden request for warp speed after 2 months of foot dragging and obfuscation, according to a court filing. Very colorful language coming from Musk's legal team. So we're going to keep an eye on this story, definitely. I believe that Musk should pay. I believe that Musk should pay even more than whatever it is that he initially offered. He should just round it out to about $60 per share because you don't mess with these types of things. This is showing just a bad example of how to do business. I don't like when people lie. During business deals, I don't like when they overstate things or understate things, when they overpromise or when they underpromise. I don't like any of that. So Elon Musk should, in my opinion, definitely pay, and we'll just see where that story is going. We'll check up on it later. Going on to our final story of the day, Netflix reports loss of 1 million subscribers quarter. So Netflix had reported previously that they were losing subscribers, but it wasn't to the call of 1 million. 1 million seems like a huge number, and it is going to affect them. They recently started adding advertising also to the streaming service, which can result in more loss of revenue. We'll check it out. Let's read. It says Netflix reports loss of 1 million subscribers in the last quarter. That's better than what it initially predicted. The streaming platform said earlier this year that it would lose 2 million subscribers in the second quarter that ended in June. So shoot for the moon, right? You'll land on a cloud. Let's see. Netflix lost about 1 million subscribers last quarter, a better than expected result from the streaming giant, which also forecasts 1 million net new subscribers for the upcoming quarter. So the company has projected a loss of 2 million subscribers earlier this year. We were all predicting, things going on with the lockdown, that it would stay more or less the same during this year. A lot of the regulations for COVID have been easing during the second quarter of this year, but it's still a very volatile situation. So the company had projected a 2 million subscriber loss earlier this year. The 25-year-old company reported its first quarterly decline in subscribers, about 200,000 in more than a decade. The company's shares were up as much as 8% in after hours trading, and Netflix share price has declined 67% this year compared to the previous year, though it remains the largest global streaming platform with more than 200 million subscribers worldwide. So, did they make losses? Did they lose subscribers? Yes. Are they still the biggest streaming platform worldwide? Absolutely yes. So Netflix is still a giant. Netflix is still one of the bigger players in the streaming uh, industry, and they're going to continue to be solid. They're going to continue to restructure and plan ahead. I they're practicing mixed martial arts over here. Netflix is moving every which way. It's trying to practice jujitsu, and when there's all this pressure from all this volatility in the market. We're on lockdown one day, we're not on lockdown the next day, we're back to lockdown. There's more things to worry about, and everything is has a lot of moving parts right now. War going on in different parts of the world, and I'm very, very convinced that Netflix is going to survive as one of the bigger players in the streaming industry, possibly the biggest one. And I have no worries going forward about Netflix. Buy some stock, buy some Netflix stock. I'm sure it's underpriced right now, and it's going to do great things in the future. So, in its quarterly letters to shareholders, Netflix said it was concerned about the pace at which its revenue would grow going forward. The company reported approximately 8 billion in quarterly revenues on Tuesday, a marginal improvement over 7.9 billion it reported in the previous quarter, so slightly better. Re-accelerating our revenue growth is a big challenge, Netflix said. So why is growing more revenue always the objective? Why can't you just be like, hey, I made enough. I made just as much money last year as I did this year. I'm happy with that. No, the growth. I'm sorry. The revenue has to grow. Exponentially, or else the company is doing bad. That's BS, my man. I hope that we can grow out of that mindset. Anyways, we've been through hard times before. We've built this company to be flexible and adaptable to this, and this will be a great test for us, the statement read. The company re-emphasized its strength in the streaming landscape. We consider an optimistic. We are confident. I'm sorry, and optimistic about the future. The company said. Netflix also confirmed it's planning to roll out a lower cost plan that would feature advertisements, though it did not say how much that plan would cost. So they're trying to, like I said, they're trying to do some judo moves. They're trying to say, okay, maybe our subscription, we have to restructure it. Maybe we'll do some ads for a $1 subscription, which I believe is how they started. They started, I think, selling DVDs or renting DVDs over the mail, but it seems like they're always thinking about what they can offer, changing that offer in order to fit the demand, the current demand of entertainment. So I think they're going to be just fine. It says the new ad-supported plan will not replace current ad-free subscriptions, so it's just going to be something additional, an additional plan that they can add to get people that are not currently subscribed to subscribe. So those are the news and those are the headlines for today, which is Friday, July 22nd of 2022. I hope that you enjoyed. I hope that I have read something that is interesting to you. Connect with me on the social platforms. Make sure that you interact with this video, giving it the thumbs up, the comments, and everything that makes the algorithm moves, and that way I can continue to provide the daily headlines for you. In the next video, I'll be talking about such companies such as Arizona Tea, which is doing great things, not raising their prices and taking the losses. Other companies, we're gonna talk about some very interesting things. So thank you so much for your time and your attention. I hope that you have a great day. Bye bye.